seventh, 1 1/8 for the Dow, almost 1.5% down for NASDAQ, about 1 1/3 down for the S&P 500, about 1.5% down for the Russell. And if you look at the heat map, and we look at a full heat map, you can see biotech is the area that's up. Biotech tends to be asymmetric. And what that means is biotech tends to not move with the economy, but with the performance of individual companies trying to invent drugs. Everything else is pretty much red, with the exception of some small electric vehicles. Mondelez is up, and you probably know about this company, United Natural Foods, down 26%. By the way, this is the mover of the day. We've already read their earnings release. And the thing that surprised me, so this is United Natural Foods. United Natural Foods didn't do so well. They revenue went up 2%. Here's their, so you go to SEC website, Edgar, you type in the URL. I'll show you how I get to it. Company search, right here. Company search. UNFI, United Natural Foods. And you see, hey, today, January 26th, you get a current release. So you scroll down, it's today's data, and it says, oh, there's a press release. And you look. So what happened is their earnings have dropped, their gross earnings. And the place I don't understand, this is a wholesaler, is that they lost based on, they decreased inflation-driven procurement gains. So they're not kind of squeezing more profit out of inflation, but also shrink. So they have more theft in their system. How does a wholesaler have more theft in their system? That actually sounds a bit like organized crime or inside jobs. And so I don't know how you prevent that kind of skimming in this type of business. And so it's one thing to say, hey, I sold less natural foods, I sold less granola bars, I sold less cereal products. It's another to say they stole trucks from me. They stole from my warehouse. And what we see here is we see a pretty significant increase, 2% increase in revenue for the whole fiscal year, almost 5%. But you can see adjusted EBITDA, which is kind of their statistic, down 56% on the quarter, down 23% for the year. So it kind of looks like an issue that we wouldn't know how to fix, right? So we can't buy that stock. We can only watch it die. And so I'm really sorry if you work for United Natural Foods, but they're stealing the stuff off your trucks or out of your warehouses. That's not helpful. So if you look at the stocks we were tracking, right? So you see the QQQ, NASDAQ, S&P 500, the Dow. Those are all down between 1 1/8, 1.5%. Interestingly enough, Digital Turbine. So Digital Turbine is a stock that we follow. By the way, we have a position in AppLovin. We're short AppLovin. We have no position in Skills or Digital Turbine or any of these others. So it's interesting, AppLovin's having a pretty good day today, up almost 1%. Skills is up because DraftKings is up. And Digital Turbine is down probably because the whole application space is down. So what else do we see? For the S&P 500, you're down to 4275. We called a top recently at 4600. Now, I'm not going to say we're experts in the space because honestly, no one's really an expert at forecasting the future. But what we saw is we saw the market reaching this peak. It was an intraday 4602. And we just didn't see it. We didn't see the volume. We didn't see the momentum. Our model was screaming sell, sell, sell. And so we sold. We've been net short for a while. And if you take a look, you're actually dropping down now below the neck. So if this is a head and shoulders pattern, you're actually falling between the neck, where the neck is at 43.28. And so, yeah, if this continues to fall, this thing drops like a rock. S&P 500. If this is a head and shoulders pattern, which it looks like it, then this is a little bit scary for us, for all of us. So you could see this shoulder, this head, with a real firm block here, firm block here. There's a neck here. Then you see a shoulder and a shoulder. And so if you draw across, I guess you could say that this is your shoulder. Yeah, it starts to break through this number, and there's not much support afterwards. So we're not a very optimistic participant in the stock market right now. We are net negative, we are short, and so why is that, Jeffrey? Why would you be short? Well, one of the things is if you look at the VIX, I'm going to walk you through very specific things that bother us about this market. And I'm going to do it really the only way I know how. So let me pull up the pages for you. So the first thing is a volatility index. And by the way, we have a website where we talk about all this. I didn't update it today. Actually, I didn't update it yesterday either, because yesterday was Yom Kippur. Hopefully you guys had a good fast. We had a good fast. I had a good fast. It was a really hard fast. So short-term interest rates, how we doing? What we talked about on Friday was they were flat. You know what? They're still flat. We're at 5.32. You're going back months now. Months. And you're from 520 to 530. I'm going to draw some doodles on all of these. These are not professional doodles. These are just to make a point. Take a look at that. So what we're finding is the market has been relatively flat in terms of short-term interest rates since June. So, okay, flat. Then we take a look at the 10-year. Now, the 10-year recently decided that it would pop higher. A lot of reasons why that might be. We're not an expert, per se, on fixed income, but if you take a look, this curve continues to rise. It was flat at in the second quarter. It rose dramatically in the first quarter. So, but this is a very, very real trend higher for interest rates. This is the 10-year. This is what underpins like mortgages, residential mortgages, even some commercial mortgages. Because if you're going to lend money for 30, they're going to prepay it. It's like 7, 10 years, that kind of thing. And so at 4.5%, you're really high on interest rates. And so the other thing that's high. So if we go back to our page, long-term interest rates up sharply. New continuation of rising interest rate trend. It did flatten for a while. This page is just called top10.html. So chicagoquantum.com, top 10. Easy to find, easy to understand. Try to make it simple for you. Get rid of that. So let's go back. So we talked about the 10-year. Some people don't like to look at rates. They like to look at prices of the bonds. Because if you're buying the bonds, we're just going to trend line it. If you're buying the bonds, here's what's happening. You lost your butt. You lost 5, 6, 7% on your money buying bonds. Now, I don't buy bonds to lose money. I buy bonds for yield, and I hope as interest rates fall that I make money on the bonds. But if you think interest rates are going to continue to rise, that's a pretty aggressive straight line down here. You stay away from bonds. You stay short. Short, you're in 5.3. By the way, the 6 month, 5.58. The 3 month, 6 month, 5.52. By the way, this is FINRA Morningstar. Great website. By the way, FINRA manages us as a registered investment advisor here in Highland Park. They got all this great statistics for you. But the thing I always look at is the Treasury benchmarks. And the Treasury benchmarks show a nice, almost 5.6% interest rate on your money. And by the way, you don't even have to pay an advisor like us. I wouldn't. That's stupid. I would go to Treasury Direct. Sorry, not Tread. Treadstone. TreasuryDirect.gov. Take a look. See all auction results. How about today's auction results? We could also look at the top, 42 days, paid 5.4. So 42-day Treasury bill is paying 5.41 investment rate. That's terrific. 5.4%. God, that's on 100 grand. You're making $5,400 in a year. That's a lot of tacos you can buy. That's real money, okay? So I would say don't be afraid to earn interest. That's why the long-term interest rate probably matters more, because in the short term, we've been running 5.25, 5.5, even above 5.5. So anyone who's got short-term money has been parking it already. It's a long-term money that you think about. Now let's look at so if you want to put money away and you want to earn interest, go to treasurydirect.gov. I mean, of course, it's all legit and legal. You got to pay taxes on it and everything. But, the money transfers right from your bank account right into the Treasury. You could pull the money right back after it pays out. You could put it in for 42 days. You could do up, I think it's like $1,000 or higher. And you can invest money. No cost, no fees. We use Treasury Direct. We invest money by lending it to the U.S. government. We think it's great. So I'm suggesting you might want to do it too. So what else we got? Let's get rid of some of this. I mean, AppLovin, again, that's a stock that we like. We like to go to zero. We actually think this is not a great stock to buy. We don't see it as a buy. We see it as a sell. And but there's a lot of reasons for that. So I wouldn't act on our account. I would act on your own against AppLovin. Let's look at the dollar. U.S. dollar. It's up again. So what's it look like? It is up again. Quarter point. Look at that trend. I don't know about you guys, but so here's the thing about the U.S. dollar. And we're not going to look from the bottom because that's overly dramatic. Let's look from over here where it was flat. That's a pretty big trend line. That's up 4.8% in 80 days. Whew. So what happens is a U.S. company, IBM, which we used to work for, Hewlett-Packard Enterprises, Hewlett-Packard Enterprises, IBM, Microsoft, great company, Google, great company. They do business outside the U.S. They make a profit. They bring the profit back and they report their earnings. Any profit they made in May was worth 5% more in U.S. dollars than a profit that they make now. So in a way, it's like a haircut on foreign profit. That's why they say that the dollar is a negative beta investment. The dollar is bad for stocks. I'm going to show you that that's true, actually, based on the last year of data. So I like that one. That one's really important. Let's look at the VIX. So the VIX, it's hard to see it on this chart because honestly, this chart has almost no pattern. So let's look at the trend line. And you see the trend line's actually pretty flat. And that's odd. Okay, that's very odd. Let's draw let's do an average. So it's up slightly above the average. It's been lower. And only just recently, only like mid-September, did it actually start to jack higher. If you want to see that, that is crazy. That is some crazy action right there. So this is the price a volatility insurance. This is how much volatility people are pricing into options for U.S. equities. And you see, it's been around 15.57 for the year on average, but you're at 1865. So here's the part that doesn't make sense. So the VIX is up. By the way, VIX also has negative beta. VIX is bad for stocks because if you're going to buy stocks, a lot of times you want to buy insurance. So I don't do that, and sometimes I just get slammed in the market. So let's say you got $1 million, okay? And you want to buy Google stock because you think Google's the cat's meow. You think it's great. We do not have a position in Google, other than the fact that we own the S&P 500 and other mutual funds that may have positions in Google. But you want to buy Google. You love Google, right? You use your search all the time. You love it. So you buy $1 million worth of Google. And it drops 20%. You lost $200,000. And now you're like, oh, shoot, I did a bad thing. So most people want to hedge. If they're going to buy one stock, what they'll want to do is buy like an option contract or sell an option contract to make sure that they don't, get hurt. And so they might buy a put that pays you if the stock closes under whatever the price is now. Let's say it was 100, now it's 100. So, but that insurance cost me, let's say, 5%. That's a lot to pay for insurance on a stock. When the VIX goes up, the insurance goes up. It makes it more expensive to hedge. It also means that there's just more kind of Wild West going on. And most investors I know, or that I would speak with, they're not looking for a bull ride. They're not riding the bull where they put money in the stock market. They want to ride a gradual merry-go-round that just prints money. They want it calm, easy. And every year they make 15%. I mean, who wouldn't want that, right? As opposed to up 50, down 50, up 20, down 20, up 10, down 10. You get a heart attack from that. So most people don't want variance volatility. There's a lot of volatility in the market. The average is 15.6. We're running 18.7, so we're much higher. We're 20% higher variance. Now, if you look at our model and our output, stock price variance, it is lower than we've ever seen. Stock price variance, actual variance, actual volatility, historical volatility is lower than I've ever seen it before. From Thursday market close to yesterday market close, Monday market close, it's actually down to 4.00 times 10 to the negative fifth. It's down again. That's crazy. That's 6 more ticks down. It's been falling since May. It's a volatility of 3,010 stocks because 5 are gone. 5 didn't trade or did something weird. And so the VIX is skyrocketing, but historic volatility is down. There's a dichotomy or divergence in the market. But the net of it is people, money makers, people who buy options, hedgers, they don't see the current U.S. equities market as flat and safe. They're looking at the S&P 500. Let's just use the Russell because I got the Russell up here. If we look at the Russell for a year, you can see up and down, right? If I were to look at the S&P 500 for the year, looks like it's steadily rising. That looks actually pretty nice. That's a nice curve. Especially if you sold at 4,600 like we suggested on our Twitter. We had that pinned to our profile for a while. It doesn't even matter. If you sold it right now, right? You bought it at 3,600, you sold it at 42, 4,300, you're still a winner, right? And so, but this market, which is actually very low volatility, is showing up as very high volatility in options prices. So VIX is a negative beta. VIX is bad. Volatility is bad. People don't want volatility. Volatility is bad. But what I would say is you've got a separation here because historic stock price variance is down, dramatically continues to fall. The VIX, or the price of future volatility, is much higher. It's up 20% than the average for the year. It's crazy. What about the US dollar, Jeffrey? We talked about that. The US dollar was much higher. Share price momentum. This is where I would tell you it sure looks like we hit a peak. If I was climbing a mountain and all of a sudden I was here, I would say we're going down the mountain. I would feel like we were going up the mountain. Now, I've mountain climbed before. A lot. I love mountain climbing. I'm more of like a scrambler. I don't use the ropes, the pulleys. I probably should. A couple times I've gotten in trouble. But yeah, I like to walk up and down the mountain. Maybe I use my hands, got some gloves, really good boots, love it, right? And so I've done 14-mile hikes in mountains. I've not been able to walk the next day. So what happens is you're walking and it's real steep. Maybe it comes down a little, but you look ahead and you know that like you're moving up, moving down, moving up. And once you hit the pinnacle, you feel like, oh, this is great. Now, unlike a mountain, you can't look ahead with the stock market. It's just where it is. But you kind of get a feel that next couple days when it went from 4,600 to 4,400, down 5% in a couple days, you're probably like, yeah, I get it. We're probably going down now. Comes up a little, goes down, now down, now down. Now you're 4,300. Point is, you feel like you're walking downstairs. The market momentum is negative. So what I had said before is it's choppy without direction and it's flat. But given what's happened the last couple of days, I feel like we're starting to turn into negative momentum. It's not great. Now, government sales of debt for cash, which is a whole liquidity play. I didn't look at that. Inflation hasn't really changed since we last looked. But one of the things about potentially a government shutdown is a government shutdown has two effects on the stock market. And I've not written a paper on this, PhD level paper, but I'll tell you this, in my mind's eye. If the government shuts down, they spend a lot less. So a lot of contractors are going to go home. A lot of money's not going to get spent. Transfer payments won't be made. Investments won't be made. We probably don't send money to Ukraine. We're not sending money to your town to build a road, build a bridge, build a school, start a program. We're not driving employment. In fact, we're going to drive down employment. On the other hand, we don't have to borrow anymore. We're not doing deficit spending. Now, we still have to pay the interest we had, and we still have to pay our, I think what they call non-discretionaries, your Social Security, unemployment, whatever, welfare, Medicare, Medicaid, all that stuff. But anything discretionary, we stop spending for the most part. And so that means less borrowing. That means keeping money in the hands of the people. So what I would say is, I don't know what's going to happen if we shut down the government, but my guess is it's actually positive for stocks in the midterm. Short term, it's bad for stocks. People will be scared. Midterm is probably good for stocks. Long term, if it results in a smaller government spend, if it results in less borrowing, less spending, a systematically smaller deficit, that's good. Now, if it means raising taxes and spending, that's bad. Because when you raise taxes, you pull money out of the economy. When you raise spending, you add it back. But you're taking taxes from the most productive and you're giving taxes to the least productive. So you're misallocating money from the most productive parts of our economy to the least productive parts. Now, there's a moral and ethical reason to do that. Poor people don't want them starving on the street. Maybe you feel like rich people can afford it. But that rich person got rich because they were really effective with their cash. And the poor people got poor because when you gave them money, they just spent it. They didn't invest it. Most poor people I know don't have a portfolio of stocks and bonds and real estate. And they're not driving innovation in quantum computing. The poor people are just living hand to mouth. So, I'd say it in the short term, it's negative. In the long term, it's positive. A lot of fear. So, what else we have? How's the market doing right now? So I think it's down more. Well, the Russell looks better. Let's see. Let's go back to I like the FinViz chart here. It's pretty much blood red across the board, with the exception of biotech. Even healthcare fell. Even healthcare fell. Retail's down. Tobacco's down. What, people aren't going to smoke if they shut the government down? Utilities are down. Basic materials. The whole financial sector's down, with the exception of Barclays PLC out of the UK. Barclays must have done something right. And there's a tiny bank, Green Dot Corporation, is up. But everyone else in the financial services is pretty much down. And there's a tiny bank, Bank First Corporation. So it's bad. Whole market's down. It's crazy. Right? And so how do you feel? Well, let's look at futures. Copper's down to 364. So this is low. When copper drops below 375, I look at it as a sign that people are afraid that the actual economy, the production-oriented manufacturing economy, is going to shrink. Now, silver down also is a factor of manufacturing. So silver, platinum to some extent, copper, gold is a whole different set of flows. You can see crude oil is still over $90 a barrel. Natural gas at 285 is actually pretty high relative to where it's been lately. Interest rates, so the 10 years at 108, 108.06 is low for it. It means we've really seen 10-year yields raise. But the thing I focus on is copper. So the fact that copper is down, it's not quite down where it was last year when we really did feel like we had a recession that wasn't really a recession. We're looking pretty low now. Copper's down, so it's a bet. It's a really bet against the economy. Again, we see the S&P 500 is breaking the neck of its head and shoulders pattern. VIX is high, continuing to drive higher. So now I want to prove some of the things that we talked about, because I don't know that you necessarily want to just trust me. Hey, Jeff, we trust you, don't worry. I wouldn't trust me. I'd want to know, Jeffrey, why do you think those things were true that you told us? So let's take a look. This is the model run through yesterday night, through yesterday market close. Couple things. Because now, if you were a client, you paid $100 for the run. You got this run. Maybe you got even a little management report. Maybe you got a spreadsheet. Of course, you got a spreadsheet. You get this spreadsheet with all the stocks. Every single stock and ETF that we had in our model with all this different data in it. But let's go back over here. So, Jeffrey, what do I got? So the S&P 500 variance is 2.2 times 10 to the negative fifth. So that's low. Just telling you, that's low and it's falling. Expected market return is 8.4% plus your risk-free rate, which is 5.58, which puts you at like 14%. And actually, if you look at the actual way that the stocks have been trading against the S&P 500, the expected return for all 3,010 stocks that we analyzed in our run is higher. It's like 15.5%. That's a great return. Prices are dropping. Returns expected rise. So let me say that again, because I'm not sure everyone understands that. I'm just going to drop it in this note on a UNFI. When stock prices fall, the future expected return rises. Wow. Well, think about it. If stocks were at 100, they were worth 100 times the number of shares. The stock drops to 90, it's at 90 times the same number of shares, assuming within a day there's the same number of shares, same number of companies, same number of stocks. And so when prices fall, expected returns rise. Now, we have our own metric to look at that. We look at the market cap of all the stocks that enter into our model. And right now the sum is $50.0 trillion. It's exactly $50 trillion. The market is worth $50 trillion. Okay, Jeff, that's great. What was it like a week ago? Go to our website, chicagoquantum.com. go look at market information, top drivers, top stock market drivers. It's called Top 10. We updated it September 22nd. I'm not spending all my time giving out the free info, but so on September 21st, total equity market cap was 49.9. On September 25th, it was 50.0. So for all the changes in the market, for all the ups and downs and backs and forths, because I watch Bloomberg. I'm a subscriber of Bloomberg. I like Bloomberg. Okay. Oh my God, Rome is burning. Markets are crashing. I don't know what to do. Worry. Hedge funds are worried. I read that hedge funds were shorting and they were going long. I don't know what's going on. Everything's crazy, right? But equity market cap only was affected by 0.1 trillion to the positive since September 21st. So share prices are choppy without direction. Now, how does that square, Jeffrey? How does that square with the S&P 500 being lower? Well, that's a great question. Because when you look at the S&P 500 from September 21, this is a one-day chart. Of course, it's not going to be easy to look at, but let's try. On the September 21, we were here. Now we're here. We were here. So Thursday, right, the 21st, we were here. Now we're here. We're down like 50, 60 points. We're down 1 or 2%. Right? 1 or 2% would be 0.5 trillion. But we're not down 0.5. We're up 0.1. So the S&P 500 does not reflect the total market capitalization. Well, if that's the case, why do we use it? Well, we use it because I don't know why we use it. It's popular. It's popular. It's sexy. I don't know. Let's take a look at the NASDAQ. The NASDAQ from the 21st was right around 13.3. Now it's 13.0 to 13.1. 13.1. So you're down like over 1%, but yet market's up. So be careful when you rely on the indices. The indices do not reflect an equally weighted portfolio. They reflect a market cap weighted portfolio. So if you own NASDAQ, if you own the S&P 500, you own large caps. And so you own big stocks. Let's take a look at full 1 week performance. Everything looks red. Let's now take a look at market cap. Anything over 10 billion. So what's interesting is your large caps, not the change today, because today it's negative. Today, the big circles are below break even. But let's take a look at the change for a week. So massively negative, massive negative. So large caps are massively negative. But if you invested across the board, like our portfolio model does, evenly weighted, large cap, small cap, doesn't matter, you're up. If you just add them all up, so large cap obviously worth more, right? So an Apple is worth 2.1 trillion. And Steel Dynamics, my God, I can't believe I knew that one, 17 billion versus 2,100 billion for one stock. But if you hold a whole bunch of stocks and you value them the same in your portfolio, what our model says is you did okay. In the last 5 days, you were actually up 0.1 trillion. And so it's just something to think about. There's the big cap versus the small cap that I think everyone needs to be conscious of. So what else was I going to prove? Nobody wants to take my word for it. Don't take my word for it. All stock variance is 4 times 10 to the negative fifth. That's like to 7 digits. So that would show you if it wasn't 00. Expected return is 15.65%. So what I'm going to tell you is this. If you put your money into 3,010 stocks and you put $100 into each one, you had $301,000, and you broke it up that way, you're going to earn 15.65%, including dividends over the next year expected, based on the performance of the S&P 500, the NASDAQ, the Russell, and the betas of all these stocks. And your variance is going to be lower than it's ever been. That's not bad. So the market needs the model. Now, this is the Chicago Quantum Net Score model. It wants you in the craziest stocks. Now, it's not all crazy stocks, but it's these crazy stocks. Skills. By the way, we bought Skills on Friday. We sold it today. We made money. Digital Turbine. We bought it on Friday. We sold it today. We lost money. But we made more on Skills than we lost on Digital Turbine. So we feel good. We actually made a profit. Affirm Holdings is the favorite. And we noticed that it was going up. It came back down. Now it's flat. That stock doesn't seem to move quite the way you'd expect it to. And if we look at the other end, what are the worst stocks? Jeffrey, what are the worst stocks in your model? Sciata Mobile, Faraday Future Intelligent Electric, Crown, Electrokinetics, Jaguar, Cosmos, Micromobility, Biora, Mullen Automotive. We all know that one. Big Bear AI, Alpine for Holdings, Stronghold Digital Mining, Heliogen. These are terrible stocks. So what happens is the model has a ton of these stocks that are just, they move up and down like crazy, but they don't go anywhere. There are like a lot of volatility and no expected return, relatively speaking. National Cinemedia, Leap Therapeutics. Is it just, sorry, I get the shivers. So those are the ones that you're not in, right? So you got ones that wants you in certain high risk that are more like e-commerce. It wants you out of a lot of the biotechs, the pharmas, and then lots of other metrics. So let's take a look. What's Jeffrey? You told me that the market acts against or travels against certain things. So let's talk about it. The VIX is a negative beta. We have two things that are the VIX. We have an ultra short term 2 times, and then we just have a VIX regular. And those are very negative. So negative beta means is that generally speaking, when the S&P 500 goes up, they go down. When the S&P 500 goes down, they go up. It's not that it causes the S&P 500 to go up or down. It just is it's a casual relationship. Look at the dollar. So those are like 2 and 3 times. The dollar is 25%. So the dollar, generally speaking, when the dollar goes up, the market goes down and vice versa. So, of course, you've got your shorts. So this is how you know the model works, right? Of course, your short, ultra pro short 3x, daily small cap bear 3x. When the market goes up, they go down a lot. When they go up, the market goes down a lot. That makes sense. But when I look, that's it. Those are the only things that are holding really significant negative betas. You'll notice that you don't see gold, you don't see interest rates. A lot of things that you used to see, you don't see right now. So that's odd to me, right? So really the negative correlation is the dollar and the VIX right now. Not interest rates. Interest rates are not causing the markets to fall. It's the dollar and the VIX. So let's take a look at betas. Some of these are going to show up. Some of these relationships are going to show up. You're probably getting tired right now. If this isn't interesting to you, I guess just turn off the video. But if you like it, I'm glad you like it, and I want you to like it. I want you to be like, hey, Jeff, this is terrific. Because this is what I do all day. If you like to do it, you got to give me a call. become a client. I'll send this to you every day, $100 a day. But also, we can just talk about stuff like this. I love it. What else am I doing, right? So, the SHI, which is a 1 to 3 year Treasury bond ETF. It has a 1% beta. So, short-term interest rates are independent of the stock market. Full stop. 1 to 3 year Treasury bond ETF. When those rates go up, the treasuries go down, but it's not moving the market. Okay. What's interesting is now look at the TLT. So when 20-year plus bonds are going up because long interest rates go down, that's really good for the market. That's an 18% beta. So that's downright positive. Now that might not even be what's written in my website because this is the real data. This is important for you to know, by the way. Gold. Tell me about gold, Jeff. Normally gold and the stock market move. I thought they move negative, but they don't. Gold has a 22% beta. We'll move McKesson. Just confusing. So gold, 22% beta. So gold and the market have been going up. It's more than interest rates. So when gold's up, market's up, gold's up. It must just be a factor of cash and money and profits and make money in the stock market, stick it in a gold bar. It's actually not a bad idea. Make money in Bitcoin, buy a gold bar. Or buy a gold ETF. Okay? Anything else? No. So that's interesting. This is real data from a year, from the last year. Now, it changes over time, which is why we run it over the year. You can't, some of the stuff is like old logic. I got books from the 50s. Let me look. Here. 20 years on Wall Street. I got old books. These old books will give you those relationships. They don't call it beta, they call it relationships. This is from 1870. So, I love this book, by the way. I've read it. It's cool. Bulls and Bears, 20 years. Bulls and Bears of Wall Street. So in 1870, there were relationships. But I got to tell you, you want the... Dusty. Look at that dusty book. Love it. Love it. You should love it too. Dusty book. 1870s, these are the real relationships right now. So now let's get to Taylor Swift. I know everyone's been waiting for Taylor Swift. Jeffrey, Taylor Swift, what are you going to talk about Taylor Swift? So this is the Taylor Swift portfolio. It starts at 43.40. Got it. So Jeffrey, tell me about Taylor Swift. What's she going to buy? So Taylor Swift's got enough money where she doesn't have to take a run of the model and say, Jeff, I just want to buy the best one, a firm, or the best two. Because I don't think that's smart. I think I should have you look at all 3,010 stocks, and I should have you pick the best portfolio. Full stop. End of story. Give me the best portfolio that you can find, and I want your models to run for hours. I want you to burn that Dell server. And if you need it, I'll buy you another one. I want you to run it hot, and I want you to find the best portfolio because I'm not going to invest all of my money in it. But 5%, 10% to try to beat the market, absolutely I will. And so for Taylor Swift, we'd recommend if you want a solid edge, you're going to hold 5 stocks, maybe 6, maybe 7. To get the same 31-point edge, you'd have to hold these 5. Affirm Holdings, Cardlytics, Checkpoint, Heliogen, and Open. Now, Heliogen, you might have said, Jeffrey, I don't understand. That's one of the worst performing stocks in your model. It is. But when you put it together with the best performers, they offset a lot of that risk. So you still get a huge return relative to the S&P 500, expected return, with a significantly lower risk. In fact, you'll notice Heliogen is in all these portfolios. All of them. It wants you. It wants you to buy the good, the bad, and the ugly all together and hold it. Now at 30 ticks, you got a bunch of different options. You got 5, 6, or 7 stocks. You got 6 different portfolios. What I would recommend to Taylor is, hold 7 stocks. You get the most diversification, but you still get your bennies. Affirm, Cardlytics, Checkpoint, Carvana. Who doesn't love Carvana? The meme stock of 2021. Heliogen, Open Technologies, and TNA. So Jeffrey, what's TNA? TNA is a 3 times bull ETF for small cap stocks. So if you want to bet on small cap stocks, it's a direction daily small cap bull 3 times shares. This has a tremendously positive Chicago Quantum net score, and it has since we've been running our model. This ETF nails the Sharpe ratio, nails risk return, nails it. Has always been a great performer in terms of relative risk to the S&P 500. You do tremendously better with the TNA than you do the S&P 500. If the market's going up, you make money. If the market's going down, you lose a lot of money. So you probably want to hedge this thing. But that's interesting. So that's it. So we've got the Taylor Swift portfolio. And then last but not least, let's talk a little bit about quantum computing companies. We know a lot about quantum computing. We based our model on quantum computing. We've owned quantum computing stocks, but let's take a look at where are they. Let's pull them up. I'm scrolling very fast, so hopefully you're not getting agita. Some kind of bad feeling. Oh my God, look at this. Before we get to quantum computing, we're going to also look at steel and miners. We're going to look at the money managers. Oh, there's some very interesting things going on here in the market. We'll look at computer software services telco. Where's my quantum? There they are. Quantum companies. So quantum companies don't like markets like today. So if you take a look from Microsoft all the way down to Quantum Computing Inc., the market is lower, significantly lower. If we look at the market caps, I'm actually going to reorder them because it changed. So Qubit, which is Quantum Computing Inc., is at 80 million. Arkit, which is a UK company that does security, communications using quantum, is worth 83 million. Rigetti, D-Wave is worth 134 million. Rigetti is worth 184 million. And then IonQ is worth 2.65 billion. Now we take a look at other companies with a taste for quantum. Honeywell. Honeywell actually was putting about $100 million a year into a company, spun it out with Cambridge Quantum Consulting. IBM's got a project with Project Q and Quantum. Alibaba, Amazon, Google, Microsoft all have experiments or reseller agreements or just exposure. And if you look at Alibaba, it's interesting because the market valuation on that one is $218 billion versus like an Amazon, which is $1.3 trillion. So you get a little extra taste for quantum with Alibaba. In fact, our first quantum experiment was run on Alibaba's quantum computer out of China. And it worked. We flipped a coin. Pretty cool. So there's your quantum stocks, right? They're worth nothing. With the exception of IonQ, everything's like 100 million or roughly 100 million. So, I don't know. Not that interesting. And we don't have any positions. So, now if I look at computers, software, services, telcos, I'm going to move NVIDIA down for market cap. And you take a look at these stocks, you see it's a really bad day for B2B. Now T-Mobile looks good, B2C, but they also do B2B. Everything's red. The whole market is red, from Unisys to Apple. So, okay. So, Jeff, that's not good today. Your model said big edge in the market. Your model said 31 basis points. Jeffrey, your model said that the Taylor Swift portfolio was going to make me some money here. Well, actually, what I really said was, if you want an edge in the market, the portfolio gives you an edge over the S&P 500, over the main passive indices. 31 ticks of edge, which is much higher than you normally get. So, but if the market goes down, you want to hedge on the overall market. And so I would hedge things like the very lowest Chicago Quantum net score stock. So these are the ones that you buy. You might buy this position, and then you're going to hedge against, let's say, 2 or 3 stocks that you'd short that are the worst stocks in our portfolio that are liquid enough for you to actually take a short position. And so that's how we build our model. That's how we actually serve our clients and manage their money. And so money managers are way down today. All of them are down. Money managers are down. Steel and mining stocks and automobile stocks. So we added it. All negative with the exception of TX. That's not ThyssenKrupp. Who's TX? Oh, Ternium. SA, so out of Brazil. Down. Whole thing is down, right? So your steel and miners are down. Your money managers are down. Your computer software, services, and telco are down. Your automotive is down. Your quantum is down. Everything's down today. Now what's interesting is we bought 2 stocks on Friday, and one of them's up quite a bit. We bought Skills and we bought Digital Turbine. Now we sold out of Digital Turbine. We took our loss early, thankfully, because it continued to drop after we sold it. Skills, on the other hand, we took our profit early. We sold it at $5.39. Thank God. We sold apps at around $6. So we got out when the getting was good. We still are short on AppLovin. We're still long on Summit Midstream. We love Summit Midstream. We're so sad that it doesn't go up, but we're going to hang on to that one for a while. And then, as we've talked about, UNFI, United Natural Foods, at $13.72. The issue with this stock is shrink and declining margins. And what happened? So it is 2:17. We are going to wrap. And is there anything else to show you? Did I miss anything? I don't think I did. So maybe I'll just pop up the website real quick again and say, if you like what we do and you want this data, first off, you can complain to me that the price is too high, and I may listen. But for right now, you could buy different advisory services. You could buy consulting services, both on the tech like quantum computing tech side or regular IT tech side, or you could buy consulting services around building models and engaging in quantitative analysis. We'll do financial planning for you. We are licensed, Series 65. We'll do stock analysis. We'll run our jobs for you. We generally do a fixed fee. You make all the profit. You take all the losses. We just charge you a small amount of money to give you the report. And then we have managed accounts, separately managed accounts using a custodian, Charles Schwab, where we would charge you ongoing, but we would actually do all the work, run the models, make the positions, make the trades. So that's where we're at. Hopefully you liked it. Hopefully you liked the discussion. And oh, by the way, under Blog Insights 1, we also do blog posts. Stocks are down this morning, but our model sees greater edge or alpha from long positions. You go to chicagoquantum.com, Insights Today. Blog Insights 1, Blog Insights 2. And so we talked a lot about what we talked about here in the video, but you got it at like 8 in the morning before the market opened. And it's good. You get it fast. Or you buy the run. You would have had this last night at about 9:30 p.m. And then you could have even called me and said, "Hey, Jeff, what is this? What are you doing?" Why is the model so positive? Don't worry, it's positive. I don't know why, but it is. It loves it, right? Markets are dropping. What I can't tell you is if the market overall is going to go up tomorrow. Nobody knows that. But the model could tell you, compared to the S&P 500, where's your risk? Where's your risk advantage in the market? And so right now the market was still in an upswing. It just looks like it's going to break the neck of what might be a head and shoulders. And if that happens, you're going to see some declines. But who knows? It's hard to look at an S&P 500, which is a synthetic investment, and do a head and shoulders. You're better off looking at an individual stock. All right, anyone on the chat? Anyone got a stock? All right. So pick a number, 300. We're going to do stock number 300. This is the 300th best stock. ACRE, Ares Commercial Real Estate Corp. Now that might be different. So let's do Kraft Heinz, 301. KHC. Now Kraft Heinz is expected to have a return of 8% over the next year, but it has a relatively low variance. It is a little worse than holding just the S&P 500. It paid a 4.4% dividend over the past year versus the average trading price. So 4.4% dividend. It's going to return a total of 8.2% next year. So what do we got? If we look at it over the full screen, Kraft Heinz, we look at the daily over a year. And what you see here is it was up and down, and then up a little less, and then down. And it tried to go up a little more, and it came down. Looks like it's trying to recover. You know, when I look at this, I think, wow, it's probably just going to keep going lower and lower, stair-stepping lower. But that's the thing. You can't extrapolate the trend. Because here it was going up, and you would have said, oh, this is great, right? I'm at 44 bucks. Next thing you know, you're down to 36 bucks. So, but you can see it's low. It's down. And you might say, you know what, at $34.50, I'm getting Kraft at a pretty good price. And if I were to draw the average from now back then, oh, come on, give it to me. There, your average is like 38 bucks. So you're buying it below average. That looks like it's about a year and a half. Yeah, you're buying it below average. Loving it, right? So that's the whole point about stocks drop. Expected returns could go up. If a stock drops and the market goes up, then the expected return, if the market goes up, could be great. So you look at a Kraft Heinz, you think, okay, I'm getting it at, I don't know, 10, 15% discount compared to where it was. So now I want to look at KHC. Jeffrey, tell me about KHC. Well, I could tell you it's leptokurtic and a low variance stock. So it's a low risk, low variance stock. Leptokurtic means you do get a chance to make or lose a bunch of money in one day. But it's a low leptokurtic number. It's 5.0. The limit for us is 4.75. It's your least leptokurtic. Second least leptokurtic. It's right with Walmart. So it'll move. If you buy it, you can make or lose a lot of money in one day. So that's good. You get a little something there, a little taste. It's a $42 billion market cap. Okay. So that's interesting. So I didn't know it was leptokurtic. And, hang on. Oh, it's also got a low beta. A beta of 0.3. So Kraft Heinz doesn't really move with the market. So if you thought the market was going to go down, this might be a little safer. It's not really a growth stock, right? And so, in fact, it looks like it's been coming up. And as the market's been falling, it's been rising because it's not a growth stock. It's a safety stock. And so, all right. So that's where we're at. So that's how you would use the data, and you've got access now to 3,010 stocks that traded a certain number of shares to make them liquid. They have a positive beta. Plus, you get to know the stocks that have a negative beta, which are odd. So you can trade those. U-Haul continues to have a negative beta. So, all right, let's go back to where we are. So, Jeff, where are we in the stock market? Well, market's a lot lower. It's dropping. Markets are low pretty much everywhere. It's a bloodbath day today. It's a sell-off of tons of stocks. Okay? There's not really a safe sector. And so I guess you look at this now and you think, well, what am I doing, right? If we look at, I've had this up all day. If we look at the Russell 2000 index. Now, what's interesting is the Russell 2000 index does not trade effectively with the ETF. The ETF diverges. And we look at this over a year, and you see how it's gone up and down and up and down. It's a double top about 5 months apart. So it climbed up very fast. It dropped down. It climbed up very fast. It's dropped down. So you have to ask yourself the question, right, where's it going? Well, I don't know where it's going. It's an index of 2,000 stocks. If we look over the month, though, it's down. And if we look over the day, it's been down all day. And so Russell 2000, the 2,000 relatively small stocks, not micro caps, but relatively small stocks. And that's where you are. We would much rather be buying a handful of stocks, shorting a handful of stocks, and getting that better risk. So thank you for watching. Appreciate it. Y'all take care now. Good luck. We got a half hour till market close. Bye-bye.